You just got your paycheck. $75,000 a year. After taxes, you take home $4,600 per month. You should be doing great, right? But you check your savings account. $2,100. Your retirement account. $38,000. You're 35 years old and you have almost nothing saved. You can afford everything you want. New phone, nice dinners, weekend trips, streaming services, a decent car. You're living the life, but you're broke. And the worst part? You have no idea where the money goes. You make $75,000 a year and you're living paycheck to paycheck. Welcome to the middle class trap. You're making good money. You're comfortable. And that comfort is keeping you poor. Let me show you the 5 traps that are stealing your future. And most people making $75,000 are caught in at least 3 of them. If you make between $60,000 and $100,000 per year and feel like you should way more save than you do, stay with me because I'm about to expose the exact traps keeping you broke despite making good money. My name is Mike and I make videos about how money actually works in real life. Quick disclaimer, I'm not a financial advisor. This isn't financial advice. I'm sharing what I learned about middle-class money traps. Talk to a professional about your situation. Here's what nobody tells you about making $75,000. It's the danger zone. You make enough to afford nice things, but not enough to build real wealth. You're too comfortable to hustle like broke people do. But you're not wealthy enough to have money working for you. You're stuck in the middle, and the middle is designed to keep you consuming, not building. Let me break down the 5 traps. And I want you to count how many you're in right now. Trap number 1, the lifestyle creep. 3 years ago, you made $60,000. You lived in a $1,200 apartment, drove a paid-off car, cooked at home most nights. Then you got promoted. Now you make $75,000. What happened? You moved to a $1,700 apartment, better neighborhood, nicer place. You bought a car, $420 per month payment. You started eating out 3 times a week instead of once. You upgraded everything. Your income went up $15,000. Your expenses went up $15,000. You're not saving more. You're not investing more. You're just living in a nicer trap. This is lifestyle creep. And it's silent. You don't notice it happening. 1 upgrade at a time. Better apartment. Nicer car. More dinners out. But at the end of the year, you have the same amount saved as when you made $60,000. Nothing. The raise made you more comfortable, not more wealthy. Here's the brutal math. You got a $15,000 raise over 3 years. That's $1,250 more per month. If you invested it instead of spending it, you'd have $50,000 in 10 years. In 20 years, $150,000. But you upgraded your lifestyle. Now that $1,250 is gone every month. Lifestyle creep just cost you $150,000. Are you in trap number 1? Be honest in the comments. Trap number 2, the debt treadmill. You have a car payment, $420 per month. It's normal. Everyone has one. You have student loans, $280 per month. It's normal. You went to college. You have a credit card balance, $3,500. You're paying it down. $150 per month minimum. It's under control. Total debt payments, $850 per month. You don't think about it. It's just part of life. But here's the catch. That $850 per month over 10 years is $102,000 in payments. If you didn't have debt and invested that $850 instead, you'd have $157,000 in 10 years. The debt payments aren't just costing you $850 per month. They are costing you $157,000 in wealth you could have built. But it gets worse. Most people pay off one debt and immediately take on another. You pay off the car. You buy a new one. New payment. You pay down the credit card. You use it for a trip. New balance. You're on a treadmill, always making payments, never building wealth. That's trap number 2. Stop right now and add up your monthly debt payments. Car, student loans, credit cards. How much per month? Multiply by 120 months. That's 10 years. That's what your debt is actually costing you. Are you shocked? Trap number 3. The retirement invisibility. You contribute 3% to your 401k. Your company matches 3%. You're putting in $2,250 per year. With the match, that's $4,500 total. You think you're on track. You're doing what you're supposed to do. But here's the math. At $4,500 per year for 30 years at 8% return, you'll have $510,000 when you retire. Sound pretty good, right? But here's the problem. You need about $2 million to retire comfortably at your current lifestyle. You're building 25% of what you need. You're not on track. You're 75% short. But it doesn't feel urgent because retirement is 30 years away. You'll deal with it later. That's the trap. Retirement feels invisible. It's so far away that the problem doesn't feel real. Until you're 55 and realize you're catastrophically behind. By then, it's almost too late to fix. You needed to be saving 15% minimum, not 3%. But 3% felt like enough. Because you're comfortable now. And comfortable now means broke later. Trap number 4. The Target shopping syndrome. You go to Target for toilet paper. You walk out with $160 of stuff. A candle, new towels, kitchen gadget, throw pillows, snacks. You didn't need any of it, but it was on sale. Oh, it was cute. Or you wanted it. You make $75,000. You can afford a $40 candle. So you buy it. Same thing on Amazon. You're browsing. You see something interesting. $35. Add to cart. $50 shirt. Looks good. Add to cart. By the end of the month, you spent $400 on stuff you don't even remember ordering. This is what I call the affordability trap. You buy things because you can afford them, not because you need them. And when you make $75,000, you can afford a lot of small things. But small things add up. The average middle-class person spends $1,500 per month on non-essential purchases. Stuff they didn't plan for. Stuff they didn't need. That's $18,000 per year. Invested over 10 years at 8%. That's $274,000. You're spending $250,000 on stuff you don't need because you can afford it. That's trap number 4. Think about last month. How much did you spend on stuff you didn't plan to buy? Be honest. $200? $500? $800? That's the trap. Trap number 5. The income ceiling. You make $75,000 at your job. That's good money. You're comfortable. Why would you risk it? Starting a business sounds hard. You might fail. You might lose time. You have a stable job. Why mess with that? Investing in real estate sounds complicated. You don't know how. It's risky. Better to just keep working and saving slowly. This is the income ceiling mindset, and it keeps you trapped. Here's what nobody tells you. Your job has a salary cap. You might get to $90,000, maybe $110,000 if you're really good. But you'll never make $300,000 as an employee unless you're in very specific fields. Your income is capped, but business income isn't capped. Real estate income isn't capped. Investment income isn't capped. The wealthy don't trade time for money. They buy assets that make money. But you're too comfortable in your $75,000 job to take the risk. So you stay there, making good money, but never building wealth. That's trap number 5. Now let me show you what these traps look like combined. You make $75,000. Take home $4,600 per month. Rent is $1,700. Car payment $420. Student loans $280. Credit card $150. Insurance $200. Phone $100. Subscriptions $80. Groceries $600. That's $3,530 in fixed costs. You have $1,070 left. But then there's gas. Going out, Target runs, Amazon, coffee, unexpected stuff. The $1,070 disappears. You save maybe $200 per month if you're lucky. But then something comes up. Car repair, trip, holiday gifts. The $200 gets spent. You end the year with $1,500 saved. Maybe you made $75,000 and saved $1,500. That's 2%. You're in all 5 traps, and you don't even realize it. But here's what changes everything. Person A stays in the traps. Person B breaks out. Both make $75,000. Both start with zero savings. Person A continues a pattern. Lifestyle creep. Debt payments. 3% retirement. Target shopping. Income ceiling. After 5 years, person A now makes $85,000. But expenses are $83,000. Debt is still $40,000. Retirement has $32,000. Net worth, negative $8,000. They are making more money and going backwards financially. Person B breaks out of the traps. Freezes lifestyle. Doesn't upgrade apartment or car despite raises. Attacks debt. Pays $1,200 per month toward debt for 3 years. Debt is gone. Increases retirement contribution to 15%. Starts side business on weekends. Makes $800 per month extra. Invests everything extra. After 5 years, person B makes $85,000 from job plus $1,500 per month from side business. Debt is zero. Retirement has $68,000. Invested accounts have $55,000. Net worth, positive $123,000. Same starting point. Same 5 years. One person negative $8,000. One person positive $123,000. Different choices. Different results. Which person are you going to be? Comment below because this is your decision point. Here's what most people don't realize. You're not trapped because you don't make enough money. You make $75,000. That's good money. You're trapped because you're making middle-class decisions with middle-class money. Upgrading lifestyle with raises. Normalizing debt. Ignoring retirement. Buying stuff you don't need. Refusing to build additional income. These are all choices. And they're keeping you broke. But here's the good news. If they are choices, you can make different choices. Starting today, here's what you do. First, freeze your lifestyle right now. Whatever you're spending today, that's your maximum. Every raise from this point forward goes to investing and debt payoff, not lifestyle upgrades. Second, kill the debt. All of it. Car payment, credit cards, everything except your mortgage if you have one. Attack it aggressively. Third, increase your retirement contribution to 15% minimum. Not 3%, not 5%, 15%. That's what actually gets you to retirement. Fourth, implement the 24-hour rule. Before buying anything over $50, wait 24 hours. If you still want it tomorrow, buy it. Most of the time, you won't. Fifth, start building side income. Even $500 per month changes everything. Freelancing, consulting, online business, something, anything. Your future self 10 years from now is watching this moment. They are looking at whether you stayed comfortable or made hard choices. And they're either financially free or still trapped. They're either thanking you or resenting you. That future self is you. Choose wisely. Here's the bottom line. Making $75,000 a year should set you up for wealth. But it doesn't, because you're in the traps. Lifestyle creep, debt treadmill, retirement invisibility, target shopping, income ceiling. These 5 traps are designed to keep you comfortable and consuming, not wealthy and free. But now you see them. And once you see them, you can escape them. It won't be comfortable. You will have to say no to upgrades. You will have to attack debt when you could just make payments. You will have to invest when you could spend. You will have to hustle when you could relax. But that discomfort for 5 years buys you freedom for 50 years. Make the choice. So tell me in the comments, which trap are you in right now? How many of the 5? Be honest. No judgment. And if this video just showed you why you're broke despite making good money, smash that like button and subscribe because I'm making more videos showing you exactly how to escape the middle class trap and actually build wealth. Let's break out together.